In this week's update, the US decline is really clicking into gear now. How weak is it at the individual stock level? And a possible roadmap for 2022. My name is Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. Let's start with the usual market perspective, because clearly we're into a negative period now, and I talked about that last week. But adding to the concerns, just in recent days, we've had retail sales numbers in the US came out that were really quite poor, and that surprised a lot of people. And I guess the market had already been factoring that in, because the retail sector has been in decline. If you look at the chart of XRT for quite some time now, so the market is always looking forward. We also saw on Friday JP Morgan earnings came in below expectations. So certainly that doesn't help the mood of the market. And there are also a couple of significant industrial companies that also missed expectations. So that's just another level of uncertainty that is adding to all of the inflation and Fed fears. Companies are now starting to report concerns about labour cost rises and also general inflationary pressures as well. So there's a lot of things that are creating headwinds for the market, and we've just got to recognise that that is the situation, and that it's all happening at a time when we're getting this multiple contraction because of interest rates turning around. Now, all of what the market does in the short term is about perceptions and how it sets sentiment. It doesn't have to be based on fact. It doesn't have to be logical. It is all about perceptions and sentiment. And if the market thinks that the future is a problem, that inflation is going to go up and the Fed is going to have to raise rates more quickly than they would like, then that's how the market sets up. That becomes the reality. It doesn't matter whether it's not factual or it doesn't come to fruition. It's the perception about the future. So I would encourage everyone not to hang your hat on logic. And I think there was a comment last week where someone was arguing what was logical, and that perhaps I was overstepping my conservatism in the short term because that wasn't logical. Well, I just encourage you to abandon that and just look at what the charts are telling you. And I'm going to be showing quite a few charts this morning of individual stocks, just so that you can see the very significant difference between what is happening at the index level and what is happening at the actual stock level. It's quite substantially different. So American stocks for the week, the S&P fell just 0.3%, which doesn't look very much, but under the hood, it's a lot worse than that. So I'd encourage you to forget just tracking the indices if that's all you do. There's nothing wrong with looking at the indices if you're also looking at sectors and stocks as well. But you really need to be looking more at an individual level. And the market is being sold aggressively. There is just no question about that whatsoever. Another thing that I would mention, which comes up every month, is we got options expiry on the third Friday of the month. So it's this next Friday coming, and leading into and out of options expiry, you get some weird price movements, particularly if stocks have gone up significantly or gone down significantly. Then you can see some very short-term reversals that, again, don't make sense. They're not logical, but it's really, let's call a spade a spade. It's market manipulation is what it is. And it happens, and I guess the message is, if you see significant reversals towards the end of next week and early in the following week, take them with a grain of salt, because they may not be sustainable. Now, the US dollar was a little lower, 95.17. The yield continues to rise, 1.79. and the VIX finished at 19.2, which is still elevated. So there is still a level of concern in the market, even though the index only went down 0.3 on the week. All right, let's jump in and look at some of the charts. So this is the S&P going back to the early 2000s. You can see we're in a secular bull market at the moment. And if you look at this big picture chart, you would think, well, what's the problem? Everything's absolutely fine. The trend is very strong. And indeed, at a big picture level, it is very strong at the index level. Let's look a little bit more short term. This is the daily chart. So right over here on the left-hand side, we're looking at November 2020. So we're looking at about 14 months of price history there. And you'd have to say, well, this is still a very robust market. There's nothing dramatic going on here. But let's go a little bit deeper and start to look at some of the spread charts that I keep a very close eye on. This is the NASDAQ 100 divided by the S&P index. And right over here on the left-hand side is 2000. So this is the tech wreck that occurred in 2000. And you can see, so the line falling means that the NASDAQ is significantly underperforming the S&P. We hit the bottom in September of 2002, and the NASDAQ has been outperforming, or technology and growth stocks have been outperforming for 2 decades now. But look at what has happened recently. And again, this is reflective of the fact that a 40-year bull market in bonds, bear market in yields, bond yields, has come to an end. And we're now in a period of transition to something else. And it's no coincidence that the NASDAQ has stopped outperforming the S&P. Now, what will happen in the future? Will this just be a consolidation, and then the NASDAQ starts to outperform again as stocks like Microsoft and Apple and Google and Amazon reassert themselves? I think that's possible. But I'll just let that play out and deal with it as it comes. I'm not forming any preconceived ideas about that. But what I do note at the moment is that you can see that in the short term, we are clearly, the NASDAQ is clearly underperforming the S&P. The line is dropping. It happened in 2021. There was quite significant underperformance. If you look at where we were in 2020 when we had the COVID crash is just there. So you can see that even though the market crashed, the NASDAQ and growth stocks didn't underperform the S&P. They were just pretty much line ball. So this period that we're in now is significant because not even the COVID crash brought undone this relationship between growth stocks and the rest of the market. So let's look a little bit further. This is the US small cap growth stocks versus small cap value stocks, or the more defensive part of the market. Well, look at the change. This has just dramatically fallen off a cliff. So clearly there is an exodus out of small cap growth stocks. And that's been going on for some time. It really peaked out in November of 2020. So we're talking 14 months now of significant underperformance by small caps. Now in 2020, US small caps did amazingly well. And if that's the part of the market you were in, which members will remember, we did extremely well out of a number of US small caps, then that was fantastic. But that wheel has turned. And you can see now that that's US small caps is just not where you want to be at all. This is consumer discretionary versus consumer staples. The line is falling. That means consumer discretionary, which includes retail, is coming down quite quickly. It's underperforming. So that's a significant change. This is the large cap growth versus large cap value. Again, significant underperformance of growth stocks. So this is all pointing towards a market that's gone very defensive. Okay, that's all that I want to show on those spread charts. Now let's look at some individual stocks. Firstly, Australia. So this is Xero. Now this is a tremendous business in Australia, but one that was just too expensive. The multiple was too high, as I talked about last week. And so we're getting this dramatic multiple contraction. And a lot of these stocks that had become market darlings are just being readjusted down in terms of their multiples. So you can look at this chart and think, well, what the heck is wrong with Xero? You know, what has happened? But it's absolutely nothing. It's just a readjustment period that the market is going through. Let's look at WiseTech Global. Not quite as dramatic as Xero, but we've got several gaps. Look at the volumes. The volumes have really picked up to the downside. So these are stocks that you want to be extremely careful with at the moment if that's what you're in. Let's look at Wesfarmers. So this is real blue chip territory, but look at Wesfarmers, how aggressively it's been sold in the last week. And look at the volumes. So if you look at the ASX 200, you would not expect to see these in a stock like Wesfarmers because the index wasn't down very much. If you look at the buy now, pay later sector, this is Sezzle. It's been absolutely slaughtered since about August of last year. We've gone from $7.80 and now we're down to $2.80. And of course, Afterpay Touch is in very significant decline at the moment. So that's the Australian side of things. Let's have a look at a few American stocks. Some of these names you may know, some you may not. This is Align Technology, which is an excellent company, but was just very expensive up here. And so we're getting this adjustment, and you just don't see that when you look at the index. Cathy Wood's ARC funds, which were, you know, the epitome of the speculative excess that occurred from the bottom of the COVID crash, where the value of that ETF went from around 35 and it got up to 160. Now we've broken support and we're clearly in steep downtrend, and we're back down to $80. And look at the volumes. This is very heavy duty selling that's occurring in this part of the market. Some of the renewable energy stocks. This is Enphase, again, a very good company. It was just too expensive up here and it's being readjusted down. And finally, I think everybody acknowledges that cybersecurity stocks have got a very rosy future. But the share price of this is HACK, which is the ETF covering cybersecurity, it's breaking down. We're getting lower highs and lower lows. All the moving averages are rolling over and we're breaking support levels. Nothing wrong with the stocks or the businesses. This is purely about a readjustment down from expensive multiples down to something lower. So that's the reality of what's going on in the market at the moment. Now, some stocks like Microsoft, etc., will continue, I believe, to be sold in the near term. But for reasons that I'll go into a little bit later in this video, I do expect some very, very significant rebounds, and that's where some of the great opportunities in terms of risk and reward can be found. Okay, the US dollar, DXY, we broke out in November. We traded up to 97. We've now come back and retested the breakout. So it's pretty critical what happens to the US dollar from here. If this support were to break, then we would, we'd likely to see a bit of a medium-term shift in the dollar. If we look at the Australian dollar, it's pretty much performing as you would expect. It's probably holding up a little better than the direct relationship, and that's largely because iron ore has done relatively well in recent weeks, and I think that's helping to provide some buoyancy to the Australian dollar. Now let's go into the Australian market. So this is the ASX 200. You can see not much change last week. I think it was down about 0.7 or 0.8%, so not a lot happening there, but shielded very much by the materials sector. Materials had a fantastic week. So BHP, Rio, Fortescue contributing significantly to that rise. And without that, the index would have been under pressure. And also without the rise in our energy sector, also contributed. Finance, pretty flat. Healthcare was down. So that's really the story of the Australian market. It's really the resources sector that is holding our market up. So just recapping, 71.58 is where our dollar sits. 0.8% we lost for the week, and it was only energy and materials that saved us. Precious metals now, gold was up $21 to $18.18. Most of that, as I read it, was currency effect. Yes, there's a little bit of fear coming back in, but look, the reality of the gold market is that it's no longer a safe haven asset as it has been considered forever. We've got such massive leverage in the futures market that it just creates ample opportunity for manipulation of price. It's been going on for years. There's been all sorts of investigations, but it's a market that's to a degree is opaque. It's the tail definitely wags the dog. It's not the fundamental supply and demand that really dictates the price of physical metals. It's really the manipulation that goes on in the futures market that really sets the price for gold. And at the moment, we're just in a period where it's just a big sideways lot of chop, and that's really all there is to it. Precious metal stocks, GDX, GDXJ, they're a little bit higher on the week, but all they're doing is just going up and down in a range. So it's not a market that I can get terribly excited about. Just quickly look at Bitcoin. Bitcoin continues to be in decline, which is consistent with the fact that we've got a risk-off kind of market, and assets like Bitcoin and other cryptocurrencies are not going to do well when we have risk-off sentiment. This is gold on a daily basis. You can see we're at the same level that we've been at. You're going to go all the way back to May of last year. If we look at it on a weekly, you can see we went up very significantly after the lows in 2019. We peaked out at just under $2,100, and we've came back to the trend, and since then we've really just gone sideways. So nothing enticing about the precious metals market at the moment. Silver looks pretty much the same. All right, turning to other commodities, copper went up a little bit to 443, but nickel absolutely exploded up to 1020 and new all-time highs for nickel. So, you know, those charts are very telling, and nickel stocks in Australia in particular are doing extremely well. Crude oil also had a great week, up to 84 and a bit, so looking very, very strong. And it's really the consequence of just chronic underinvestment for a lengthy period of time that's really going to continue, because it's going to be so difficult for for banks to lend to anyone that wants to do exploration. It's just not going to happen. So I can see that in this sort of environment that the crude oil price could really end up going anywhere, because the demand is not really slackening off. So demand stays stable, but production is struggling to keep up. So that all translates to a higher and higher price. There's the spot copper chart. So not a lot of change, and we're still at the same level that we were at in the middle of 2021. But it's the nickel chart. You can see really took off in the last week. So that's the 1 year chart. Let's look at it on a 5 year chart, and you can see since the lows after the COVID crash, the nickel market has been very strong, rising from $5 to now be in excess of $10. Now, let me just give you a bit of a roadmap based on probabilities for the US market for 2022. Now, these aren't predictions because I don't do predictions. These are just observations based on looking at charts, but also looking at some of the data that underpins that and how that's likely to impact sentiment. So in the next few weeks, I would expect the market to be net down, but choppy, backwards and forwards, because once good quality stocks get sold off or get oversold, then there's an inevitable bounce, which gets caused by short covering rallies and all those sort of dynamics. So I'd expect the market to remain pretty choppy, but net down. This Friday coming, we've got options expiry. There are particular dynamics around that where we get just overt manipulation of market pricing. And that's overlaying everything that I talked about last week, the bigger picture multiple contraction because of the multi-decade reversal in interest rates. So that all, to me, contributes to a pretty choppy week. The next few months, so looking out until perhaps April-ish, the multiple contraction obviously continues because that's not a process that just completes itself in a matter of a few days or weeks. That will take longer to play out. It's just the reality of the amount of money shifting from one style of investing to another. So that multiple contraction is going to continue. The inflation data is going to continue to look bad, and that is going to cause some fear in the market about any changes that might occur to Fed policy. So I think it's reasonable to expect that while those inflationary numbers continue to look poor, that stocks trading on high multiples will continue to get cut. But as we get into April, perhaps May, the inflation data should start to moderate because the low numbers from 2021 are going to start to drop off, and the comparisons will be made against higher numbers in 2021. And so I think everyone in a few months' time is going to start to relax a little bit about inflation. And once that sentiment starts to take hold, then I think we're going to see a reassessment of quality stocks. And quality growth stocks, I think, then have the potential to really explode higher because inevitably markets overshoot in both directions. They overshoot to the upside, everyone gets too excited, they get too bullish, there's too much speculative excess in the market and it gets washed out, but in the process it goes too far to the downside. So I think we're going to see wonderful buying opportunities in quality growth stocks, both in America and in Australia. It might still be a few months away and it'll probably be pretty choppy in the process. So you've just got to get through these next couple of months. Now, having said that, they're all general comments about the market as a whole. Within that, there will always be individual stock opportunities. There will be some stocks that will do really well in the next few months. It's just there won't be many of them. You're going to have to be extremely selective about what you're in the next few months. But there's no question, and particularly with a lot of the Australian small cap battery material stocks, I think some of them are going to do extremely well. They're going to be driven by good drilling results. They're going to be driven by offtake agreements. They're going to be driven by all sorts of positive news flows. So, this is not a blanket negativity on the market at all, but it certainly is a time for caution. So wrapping it up, my final thoughts, we're going to get tested in the next 3 months. If you're not prepared for pretty choppy conditions and to have your emotions tested, then you're just not being realistic. It's really important to understand with what you're holding that you need to understand why you're holding it. What is your purpose? Is it a short-term trade or is it a longer-term hold based on the conviction of that particular business? So if you don't know why you own something, then you better get out of it, because you're going to be hit with a lot of confusion and uncertainty. You need to understand for those stocks what your exit signal looks like. And in the memberships that I run, it's very clear what the exit signals look like. You don't have to know where they're going to happen. You just need to know what they look like, and as soon as they happen, then you respond. The more you can pre-think your actions before things get unstable, then the better off you are. You need to have a target list ready. You don't want to be rushing around when there's some sort of big market reversal off the lows, scrambling to try and decide what to buy. You need to have a good idea in your mind now what it is that your target list looks like. And resist the urge to bottom fish at the moment, because a lot of stocks that are going down very strongly, like the ones that I showed you and the ones that I showed last week, they're going down for a reason. So I would be looking for the stocks that are most resilient to the selling. You want to be looking at the stocks that are selling off the least, not the stocks that are selling off the most. And I think the current outperformers will continue going forward to be the best option, but that doesn't mean that the current outperformers can't themselves have some significant dips before they rebound. Now, portfolio analysts, last week we did a review of activity in the previous period, which wasn't all that much, to be honest, with the Christmas period, and we also looked at the portfolios within portfolio analyst as well. So that's it for this week. There's more information on the website. There's my email address. And just a note, next Sunday there won't be a weekly video. Unfortunately, I'm otherwise committed. So I'll be back with you the week after that. So let's see how things go. I think it's a public holiday in the US on Monday night. And we've got options expiry on Friday night. So I think whatever happens, it's going to be a pretty interesting week. I'll be back with you in a couple of weeks. Cheers.